everyone, it's Laura Radulovich with Keller Williams Classic Properties, and I am joined today with Jason Harris from Guaranteed Rate. Jason, if you have not met him with me already, is the #1 lender for closed transactions in the state of Ohio, and a great friend and educator of all things lending to me. Jason, how's it going today?
I am doing well, Laura. I really appreciate you having me on, and excited to talk with you a little bit about the market today.
Great, thank you. I'm sure you're getting this question all the time, and not only am I getting this next question, but I'm seeing it in comments every time I read an article online about the real estate market. I make the mistake of going into the comments because I want to see what people are talking about, and everywhere I see is, this is going to be 2008, the bubble's going to burst, there's a bubble, etc., and no one should be buying right now. And I want to get the truth from you. I know that it's not true, you know that it's not true, but I want to explain it kind of in the best terms possible for those who might want to be listening. And in my opinion, I think there's 4 reasons why this is not 2008. And #1 is really goes right to you. Lending standards are totally different right now than they were back then. Talk to me a little bit about what the differences are.
Yeah, I think that is certainly a key element. I started in mortgage back in 2003, and was actively involved in the industry during that 2003 through 2007, where we saw a really big run up in prices. And during that time, lending standards, they went to a place that it's really even hard to imagine looking back. But we did not have, in most cases, to verify much of anything for buyers who were interested in taking out a mortgage. Very few loans required any documentation related to income or assets. So if you can imagine, we were loaning money without really checking to see a borrower's ability to repay. There were credit score requirements that, as low as 500 credit scores were eligible for financing. In fact, there were loans where people with as little as a 580 credit score could actually do 100% financing at the time with very little or no down payment. And so when you think about the lack of documentation, the credit requirements being so far removed, from what we view as normal today, and then you combine that with a lot of the products that were available then, most loans, I would wager to guess that maybe 50-60% of loans originated in 2006 had adjustable rates. So, we were set up for a problem in 2008, and what occurred then was really in direct correlation with the lending standards that were in place at the time. And now it's very different. I mean, everybody hears about kind of going through the mortgage process and dealing with the all of the box checking, the I dotting, the T crossing, and that's really how we do it. I mean, to this day, really since about 2010, the process of borrowing money is one where we're going to check everything. We're going to verify every borrower's ability to repay. And so we really originate high quality loans. So the folks that are out there in the market today that are buying, you can rest assured that their ability to repay has been vetted very, very carefully.
That's so crazy to think about someone with that credit score just not even bringing anything down. That has definitely changed. What I think is kind of #2 that's a big difference, and I've heard the term foreclosures being thrown out by people. Definitely heard a time or two someone saying, well, I'm just going to wait for all of these mortgages to default and get myself a cheap foreclosure on the market. And I can see where someone would think that for sure. I mean, back in 2008, where there was an influx of these foreclosures, pumped into the market and really pumped that supply with falling prices. And not only that, but prevented then the buyers who foreclosed, they weren't able to buy anything for 7 or 10 years. And so there was less people buying, but there's not going to really be many foreclosures this time around, in my opinion. What are your thoughts?
Yeah, so what we're hearing a lot about, and is that there was a forbearance program that was put into place through Fannie Mae, Freddie Mac, and then for both FHA and VA loans, the opportunity after the outset of COVID and some of the job losses that resulted from that, for borrowers to postpone their mortgage payments, for as much as now 18 months. Um, right now, we're at somewhere around 1.7 million, households that currently have a mortgage in some stage of forbearance. But really, the vast majority of these borrowers are, going to resume payments. In fact, one of the unique things about this particular program is there was not a rigorous process for documenting the need for the forbearance, and I think the effort with that was to kind of get help out in the most efficient way possible to those who needed it. So there are probably a decent number of folks out there that are not necessarily making their mortgage payments that arguably could, and so as we see the forbearances roll off, we're seeing the numbers come down. They've come down 60-70% where people have begun to make payments. And, I expect that we'll see that number continue to be whittled down over the next 6 months or so. At the end of that forbearance period, there will be some folks that, have suffered, losses in their employment that may not be able to stay in their homes. And there will be some supply that hits the market as a result of that. But there will be nothing like the tidal wave of foreclosures that we saw in 2008, 2009. The vast majority of the loans that were going into foreclosure in 2008, 2009, 2010 were loans that were actually not backed by Fannie Mae, Freddie Mac, FHA. They were loans that were, private label. If you think about some of the big banks, Bear Stearns, Lehman Brothers, some of those banks that we hear about from the financial crisis. So there were not programs in place to mitigate that, to slow down those losses and people losing their houses. This is going to be a far different experience. This I have no concerns of that looking anything like 2008.
Yeah, that's great to know. And in my opinion, kind of brings me to the third difference, which is equity, which I think also is going to prevent a lot of those from those homes from foreclosing. Whether or not if someone maybe is still unemployed or now they're underemployed, and once forbearance rolls away, they're not able to make their payments, there's a good chance they might have equity in their home, where in 2008, a lot of homeowners were underwater. And so I think we'll see people selling that need to sell, but they should have equity. So it shouldn't be any kind of flash sale or short sale situations, since there's actually value in their home. So do you agree with that?
I think that's a huge difference. I think the vast majority of folks in that 2008, 2009 time frame had, again, put very little down in the home. We were seeing prices move down rapidly. The vast majority, we're at the highest level of equity for home buyers in the history of the country. And so to your point, if we do have some percentage of folks that are unable to resume their mortgage payments, the vast majority of those folks will be able to sell and get out of the house without a foreclosure event.
Yeah. And for those that are watching that hear the word equity, don't understand completely what it means, basically the difference between the market value of your home and the amount that you still owe on your mortgage. So if you bought a home a few years ago for $300,000, put 10% down, then you mortgaged 270,000. Let's say now it's worth 400. So whatever that difference is between what's still left on your mortgage to what the value is, that's your equity. And so having, I'm seeing a lot of people that didn't put a ton down a few years ago, but now they have 50, 80, $100,000 in equity that they now have. Kind of once they sell, they'll have that cash. And a lot of that too ties into just keeps naturally leading to the next point. The last point is 4 is appreciation. That prices have appreciated so quickly over the past few years. And I know that I was definitely surprised post-COVID that of this kind of sales boom, but with everyone taking advantage of record low rates. And I think a lot of first-time home buyers, a lot of millennial home buyers, I've read a lot of statistics at that biggest chunk percentage of buyers are millennials buying their first home, where even with this appreciation, their mortgage payment is still less than what they're paying for rent. So it's kind of a no-brainer for them.
Yeah, it's I think a lot of us have been a little surprised about the way the market has responded, as we've gotten through COVID and dealt with COVID. But what I'm seeing is people view housing differently now than they did, and you'll hear talk about that. It's every day when I'm talking to clients that are, looking to move. It's about having more space. People need the home office. They view their house as more of a focal point within their lives, and it's really causing just a much higher percentage of people looking to enter the market. I think in a normal year, they say about 10% of people would like to move, try to move. The most recent statistic I read that is that 28% of people would like to move in the next 12 months. So you're really seeing a lot of people look at housing differently and view it as a place that they're going to spend more time. And I think that that's driving a lot of what we're seeing in the market.
Yeah, absolutely. Because even with this kind of the record prices, like you mentioned, a home office, for example, where maybe in years before someone might have done some renovation or done an addition to their house, which is still happening, but because of the cost of lumber, it is cheaper to buy a bigger house, even with these prices, than it is to do an addition on your house.
Yeah.
It might take a year for a contractor to get to you, or find the lumber, or find whatever they need to do the project. And, I'm working at home. My husband's upstairs in a bedroom working from home. We've been doing this for a year now. So I get it.
Yeah.
I get the
it's a real thing. We are seeing, I think a lot of the suburban markets are benefiting, as people are looking for a little more elbow room. And, that trend does not seem to be abating. And to your point, the millennials are definitely the cheap cohort in the market right now. And it's kind of like the baby boomers coming through. There's just a lot of household formation, and we've spent the last 10 years building far less homes than we need to meet that demand. And we're seeing, obviously the low rates are helpful to that, but it's a demographic shift that's occurring that's causing home prices to continue to rise. I don't know that they'll be appreciating at necessarily 10% a year into perpetuity, but it's not something where I look at and say, man, we're on the edge of this slowing down. The demand is really strong. It's really strong.
I agree. All right, let's end this on something positive. I'm going to put you on the spot. Do you have any words of positive encouragement out there for anyone looking to get started in this crazy home buying world that we're in? Do you have any positive advice to give out to anyone?
Yeah, I mean, I think that, right now, again, it's still although it's challenging, it's still a great time from an affordability standpoint to buy. We've got low interest rates. I think, as we get into the spring and on into the summer markets, we'll see, I think we're making a little headway with COVID. I know a lot of the vaccine numbers are pointing in the right direction. Some of the cases are coming down. I think you'll see more folks interested in selling their homes. And so I think this is a great time to enter the market. I think it's a really important time to have a great realtor, somebody who can guide you through this process in this market. But, with low rates, making it as affordable as it's ever been to buy, I think it's a great time.
Great. I agree. Thanks so much, Jason. We appreciate your expertise. It always means a little bit more coming from the expert that is actually looking at all the loans and was there during the time in 2008 in the business. Definitely helpful. So I will drop Jason's information in this video as well, so you can get in touch with him. if you'd like to chat with him more. And of course, you can reach me anytime, Laura@lauraradhomes.com. And I will see you all soon. Thanks, Jason.
Thanks, Laura.